Imagine owning a tiny piece of a giant company like Apple or Amazon. That's what owning stock is all about. When you buy stock, you're buying a small portion of ownership in a company. This ownership is represented by shares. There are two main types of stock, common and preferred. Common stock is the most prevalent type. It gives you voting rights in shareholder meetings and a claim on the company's profits through dividends. Preferred stock generally doesn't come with voting rights, but it often offers a fixed dividend payment. Investing in stocks can be financially rewarding. If the company performs well, its stock price typically rises, increasing the value of your investment. Additionally, companies may pay out a portion of their profits to shareholders as dividends. However, stock investments come with risks. The value of your stocks can fluctuate, and you could potentially lose money if the company's performance declines or market conditions worsen. Think of a mutual fund as a basket filled with various stocks or bonds. Instead of buying individual stocks, you're buying into a diversified portfolio managed by professionals. There are different types of mutual funds tailored to different investment goals. Equity funds primarily invest in stocks, aiming for long-term growth. Bond funds focus on investing in bonds, seeking regular income and preservation of capital. Balanced funds offer a mix of stocks and bonds, aiming for a balance between growth and income. Mutual funds offer several advantages. They provide instant diversification, which can help reduce risk compared to investing in a single stock. They are also professionally managed, relieving individual investors of the burden of researching and selecting individual securities. However, mutual funds also carry risks. Their value can fluctuate based on the performance of the underlying investments. Additionally, investors typically pay fees for the management and operation of the fund. One key difference between stocks and mutual funds lies in ownership. When you buy stock, you directly own a piece of the company. With mutual funds, you own shares of the fund itself, which in turn owns the underlying assets. Management is another differentiating factor. Stocks require individual investors to conduct research and make investment decisions. Mutual funds are professionally managed, with fund managers making buy and sell decisions on behalf of investors. Diversification is a significant advantage of mutual funds. They offer instant exposure to a variety of assets, reducing risk. Investing in individual stocks concentrates risk, as the performance of your portfolio is tied to the fate of a few companies. Liquidity refers to the ease of buying or selling an investment. Both stocks and mutual funds are generally considered liquid assets, although the trading volume of specific stocks or funds can influence liquidity. Lastly, costs are an important consideration. Trading individual stocks often involves brokerage commissions. Mutual funds charge annual expense ratios to cover management fees and operating expenses. Let's consider an example: investing $10,000. With stocks, you could buy shares of a few companies you believe in. With mutual funds, that same $10,000 could be spread across hundreds of stocks within a diversified fund. Which is better? It depends. Stocks offer potential for high returns but come with higher risk. They're better suited for those comfortable with research and managing their investments. Mutual funds offer diversification and professional management, making them suitable for investors seeking a more hands-off approach and lower risk. Ultimately, the best choice for you depends on your individual risk tolerance, investment goals, and time horizon. Consider your comfort level with market volatility and the amount of time you're willing to commit to managing your investments. Remember, there's no one-size-fits-all answer when it comes to investing.